I want to get to a broader point, right? Plus 62%, and Boeing workers, if I guess they're fortunate or lucky, they're going to get paid more as well. So that's going to push up wage costs and wage growth. And usually, the classical model is as wage growth goes up, right, it moves in inversely to where the stock market goes. Do you believe that model, and are you worried?
No, I'm not. I mean, wage growth is strong. But if you, particularly for these deals, 60% over 6 years, that's do a little bit of arithmetic. That's a pretty significant pay increase. And the auto workers, when they struck not too long ago, they got a pretty big increase. Of course, Boeing's still on strike. We'll see how that plays out. But that goes to the very tight labor market. But if you look at wage growth across the economy, across all industries, occupations, everything, it's somewhere around 3.5% to 4%, which is just about where you'd want to see it, given underlying inflation and given, most importantly, productivity growth. The other thing that's going on, Martin, is U.S. productivity growth is extraordinary, and that allows businesses to continue to maintain their margins and corporate earnings, and that's obviously critical to the equity market, but at the same time pay their workers more. So hopefully these strong productivity gains continue going forward, because they're really allowing for strong wage growth, good earnings, and a high stock market.
Yeah, and we've whacked one inflation mole with the East Coast port strike, potentially, haven't we? But you've got the Middle East situation unfolding, and Middle East on a knife edge in terms of stability and disruption to oil supplies, potentially. How is that going to change the calculus in November for the Fed?
Yeah, this I worry about more. Nothing does more damage to the U.S. economy and much of the global economy than higher oil prices. It's a negative supply shock. It hurts growth because it reduces people's purchasing power, particularly lower middle income households. They have to put more of their hard-earned money into their gas tank. They have less to spend on everything else. And it causes higher inflation. So, puts the Federal Reserve and other central banks in a pretty difficult spot. What do? Do they respond to the weaker economy and growth by lowering rates, or do they respond to the higher inflation and don't cut rates or raise rates? So it's a very difficult problem. If all that we see here is what we're seeing, right now oil prices are up about $5, $10 a barrel as a result of events. If that's the end of the story, I think we're okay. The Fed's going to continue on its path, no change. In fact, oil is now sitting somewhere in the mid-70s, whether it's Brent or WTI, and that's kind of consistent where it should be in the long run. But if prices go higher, if for example, Iranian oil production infrastructure is actually damaged by whatever the Israelis do, and we get to 80 or 85 or 90. That's a different ballgame, and that's a real problem.